Okie doke, folks. Onward and upward. Chapter 3. So after this chapter, you have your first test. Remember, you have an extra week. Like, it's not due the same time as your homework for this chapter. It's due the week after that. And you get to use, it's a take-home test. You do it at home. It's like you get 90 minutes. It is timed. It's like 90 minutes. But you can use your books. It's not like proctored or anything. You can use notes, whatever you need there. So just kind of a reminder of that. Chapter 3, here we go. So in this chapter, we are going to talk about what's included in gross income. So remember, we said that income is defined as income from any source unless it's specifically excluded. So you can assume that if it's income, if it's income, that it's going to be taxable unless there's some specific law that says that it's not taxable. Okay, so we're going to go through those items that are included as gross income items, and we're going to go through some of the items as well in this chapter of things that are not included or are excluded from gross income. So first thing we're going to talk about is when and how we record income for tax purposes. So as opposed to for financial accounting purposes, that whole revenue recognition thing is a little bit different for tax than it is for financial accounting. We use the cash method of accounting for income taxes. The only time we don't use the cash method is for certain corporations. We'll use the accrual method of accounting, but we use the cash method. So we're just going to kind of go through exactly what that is. Then we're going to look at some specific components of income and how we calculate what is, of those components, what part of them is taxable and what part might be excluded. Specifically, we're going to look at interest income. There are a couple different types of, there's taxable interest income, there's non-taxable interest income. So we'll look at what those are. Dividends. Dividends have some special treatment under the tax code. Oh, looks like we've got somebody here. Hi. So dividends get some special treatment under the tax code in the form of preferential tax rates. So we'll go through how that all works. And I'll tell you what, that is one area where you will have to remember this procedure throughout the class because it's going to come up in different tax return problems. And so I'm going to kind of emphasize, try to really drive home this procedure, because this is one of those questions that I get a lot just through experience of having this class for now my 8th year. This is one of the areas in this chapter that there's a lot of confusion about it, is how to record dividend income, how it's taxed and what the tax rates are. Tax refunds. So here we're talking about refunds from like state government. So if you get like a refund from the state of Iowa, sometimes it's taxable, sometimes it isn't taxable. So we'll take a look at that. And then Social Security benefits. This is another problem area. I don't mean to predetermine the difficulties that you may or may not have in this chapter, but just to kind of give you a forewarning, Social Security benefits and how we calculate taxable Social Security benefits is also one of those more complex areas within this particular chapter. Then we'll look at some items that are specifically excluded from gross income that we don't include on the tax return. And then our appendix here, we kind of briefly gloss over this. We'll talk about savings bond interest for education expenses. We don't really get into these items below, market interest rate, original issue discount, and gift loans, they're a little bit, I'm kind of surprised they put them in here. They're a little bit beyond just kind of the introductory level. So we'll mostly in this area just talk about the savings bond interest that's used for education expenses. So let's start. All right. So revenue recognition for financial accounting purposes. Remember, we recognize revenue when it's earned, not necessarily when we receive the cash for financial accounting purposes. That is not the case in income tax, though. We have different revenue recognition concepts. So realization of revenue, as they define it here, the process of converting a non-cash resource into cash or a right for cash. Now, again, this is from a financial accounting perspective. So that realization of revenue happens at a different time for tax purposes than it does for financial accounting purposes. For tax purposes, we realize income when we receive it. We get the income in, but realization may be different from what we recognize for tax purposes. So we may realize, for example, I'll give the example of if you sell a house, sell a building in a business. So you sell a building for $100,000. You receive $100,000, right? So sale. So you realize this amount. But for tax purposes, we get to take into account what we paid for that building to determine what it is that we actually recognize. So, and this is what we call our basis. We're going to go more into this in chapter 6, but this is just to give you an illustration of the difference between realization and recognition. So if we have a basis, this is our cost. And maybe we've depreciated it over the years. We won't get into that right now, but let's just say it's $50,000. So we have a gain of $50,000. This is what we recognize. So we realized $100,000. We got $100,000 of cash, but we paid $50,000 for this building. We are recognizing for tax purposes a $50,000 gain. So that whole concept, the difference between what we realize and what we recognize is they're different concepts, okay? So what we're concerned about really is, I mean, we're going to need this information, but for tax purposes, what we're taxed on is what we recognize. So this is what we're going to be taxed on, this amount that we recognize. They use the example here, selling inventory for cash or an account receivable. The realization concept also applies to professional services, the exchange of knowledge for cash, asset sales, exchanging a building for cash or the right to cash, licensing a patent, exchanging an idea for cash or a right to cash, or wages, exchanging time, knowledge, and effort for cash. So anytime you've exchanged something for cash, that's the realization of that income. So income is earned when companies or persons have performed all actions necessary to complete the transaction. So when a grocery store sells a can of beans, it has earned the income because it has done everything it needs in order to complete the transaction. For financial accounting purposes, that's when we realize that income. So for tax purposes, it's a little bit different. So there are 3 rules for the recognition when we recognize income. So we may realize income, get income in, but for tax purposes, there may be a time lapse between when we realized it or when we recognized it. Also, we may realize income that we never have to recognize for tax purposes. That's like the perfect situation, right? So that the timing could be different, or whether we recognize income that we have realized may also be different. So the 3 things that have to happen in order to recognize income for tax purposes. First one is there has to be an economic benefit. We have to somehow be economically better off than we were before the transaction. So, and like I said, all three of these have to be met. So if someone works for an employer, receives cash for that work, that person has income, they're economically better off. Everybody's economically better off on payday, right? Than they were right before payday. Ideally. Even if you've already spent your money, at least then you can pay off whatever debt you had. You're economically better off once you receive that. Also, a benefit, an economic benefit, can be indirect. So a direct economic benefit would be I earn some money and my employer pays me. They pay me directly. I get it directly. An indirect payment would be, so I've got an example here. An accountant performs tax work for a client. The client agrees to pay a $500 debt that the accountant owes to a bank. So the accountant's not receiving the cash, but what they're receiving is the forgiveness of another debt. So they're still economically better off because now they don't have that debt that they have to pay. That's an indirect benefit. So that it was received even if the $500 of cash was never in the possession of the accountant. So that would be an example of an indirect benefit. But you're still economically better off, either because you have your assets have increased or your liabilities have decreased. So if you want to think of it in terms of the accounting equation, if somehow your equity is increased, you're economically better off, right? So that's one of the things that has to happen. Also, another thing that has to happen is that the transaction has to have reached a conclusion. And this is where it's different from financial accounting. In financial accounting, transaction doesn't have to reach a conclusion before you realize it, right? Before you actually record it. You can have income that somebody owes you, but you're going to record that revenue because you've done everything that you need to do in order to earn that revenue. So our revenue recognition principle has been satisfied, even though we haven't been paid for it yet. We have a receivable on our books, right? So, but in tax, we don't recognize that income yet because the transaction has not yet concluded. It doesn't conclude until it's over. It doesn't conclude until that person actually pays us the money that they owe us. So there are two things. First, a transaction has to occur. It has to occur in the first place. That seems kind of obvious, but simply owning an asset that is increased in value does not create income. So the example here, let's say we are building here, we bought it for $50,000. It's now gone up in value to $100,000 just because of appreciation. If we didn't sell the building, our transaction has not reached a conclusion. So we don't record this increase in value simply because it's increased in value. We record that increase in value only when that transaction has terminated, when we have sold the asset. They use the example here of stock. So when you buy a stock, so here they've got, if an individual owns 100 shares of IBM and the stock price increases by $1 per share, they still own the stock though, they haven't sold it. There's no income to recognize at that point because the transaction hasn't concluded. It's still in process. Until you sell it, it's still in process. So you do not recognize it until it has actually concluded. This is one thing, I don't know if you were paying attention during the election. One of the proposals was to generate more revenue was to tax unrealized gains. Unrealized gains are, you have an asset and it increases in value, and you pay tax then on that asset, on that increased value, even though you haven't sold it. And what puzzled me about this whole proposal was it doesn't meet the definition of revenue recognition per the tax code. It doesn't. They would have to completely change the tax code, and it would have changed so much about it. They didn't do it. They're not going to do it. I can't imagine that it would probably destroy the economy to do such a thing. But it would have violated this economic principle, this principle of the tax code, that the transaction has to have reached a conclusion. Because what they were saying was, no, we're gonna tax you before that transaction's even reached a conclusion. Okay, but this is one of the principles that we still have. So a second factor, so a transaction has to occur, and then the transaction has to be complete. So often there's a time gap between the agreement to enter into a transaction and the completion of a transaction. So the completion date is when the income is recognized. So whenever it's actually completed. So if you, for example, this example of stocks, selling stocks, sometimes you'll put in an order to sell a stock, but the order doesn't process until the next day or the next business day, depending upon when you place it. Or you maybe it's a stock that not very many people are interested in buying. So it takes some time for it to complete. Well, the completion is when it actually sells, not when you put the order in. So that's what the completion would be. Finally, the income cannot be tax exempt. So there are certain items of income that are excluded from taxation, will not be included even if those two preceding circumstances have been met. Okay, so here we've got an example. December 23rd, 2023. Raul agreed to repair a damaged roof and started work on that date. On January 6th, he completed the job and he received payment. He would record this income in 2024, not in 2023, because that's when he received the payment. Now, let's change this up a little bit. So December 29th, he agreed to repair a damaged roof and they paid him for it. They gave him a deposit on that date. But he didn't complete it until January. Well, in that case, he got the money in 2023. Now, for financial accounting purposes, we would say that that's a prepayment, still an asset, but well, it's a liability to us because we owe them the work. But for income tax purposes, we recognize that income when we actually receive that payment. So that's one of the differences, and we use the cash basis for income tax purposes. Okay, so again, has to be an economic benefit. The transaction has to be complete, and it cannot be tax exempt, which is determined by statute.